Hey folks, welcome to another episode of Business Foundations. My name is Drew Alders, President of Mobilization Funding. I've really enjoyed going over a number of the different financing solutions available to you as you grow your specialty trade contracting companies. We talked about bank lines, we talked about asset-based loans, we talked about factoring, we talked about MCAs. Now we're going to talk about project level financing. There are a number of key differences with project level financing, but if I do equate project level financing relative to all the other forms of financing, I would be comparing it to be a rifle versus a lot of the other financing solutions is really shooting with a shotgun. What do I mean by that? Project-based financing is tied to your contract, tied to your project. And the way we do it here at Mobilization Funding is we take your project, we take your contract, we take your schedule of values, and we map that out across the entire time frame of your project, right? You have costs in the very beginning of your project before you even submit your first invoice. Materials, payroll, equipment rental, and miscellaneous of other things, bond payment, for example. And then you submit your invoice and then you don't get paid for 30, 60, 90 days later. What project-based financing does is we build an entire roadmap of that project as if you don't have any capital in the project. And then we decide where on exactly which dates you are cash flow negative, where you need to bring in your own cash in order to complete that project. Now you can tweak that cash flow, you can tweak that roadmap by renegotiating vendor terms. Maybe you stretch out your vendor terms another 30 or 60 days. Or maybe you push up your vendor terms to get a discount. You pay payroll weekly or every other week. Most folks that we've seen pay it weekly. But what a project loan does, it maps that entire roadmap out for the entirety of your project. Now, most projects, with a little help from a company like Mobilization Funding, plus the cash flow that the project generates itself when pay apps start converting into cash, they cash flow themselves. And what we've noticed is it's usually the first 25% of the project, right? So when you go on a project and you start that project, right now what you're having to do, you're having to hope and pray that some of your accounts receivable turn into cash on your other jobs so that you can apply it to the job that you're currently on. Or if you've built up your balance sheet, you have cash on your balance sheet that you can allocate to that job. But when you take cash from your balance sheet or take cash from another job to apply to your current job so that you can get through that first billing cycle, so you can pay for materials, so that, because remember, the project hasn't paid you back yet. You then have the opportunity cost of not being able to use that cash to reinvest in your business and continue to grow. Maybe you need more equipment. Maybe you need more people. Maybe you need to buy a building or rent a larger building because your company is growing. But with project-based loans, those types of loans can come in and then take care of those materials for you on the front end. Take care of that payroll on the exact day that you need that payroll on the front end so that you don't have to use your organizational capital. Because the goal, when I talk about building your balance sheet, I'm talking about accruing substantial cash balances. The construction industry, specifically for specialty trade contractors, doesn't really allow you to do that unless you overbill quite a bit or unless you get deposits, as long as you keep those deposits and overbillings on the job to complete the job. But with a tool like a project-based loan, it allows you to use other people's money to generate more volume of business. What it allows you to do, it allows you to take on bigger jobs than you normally would. Because with bigger jobs comes larger materials payments, larger direct labor expenses, larger equipment payments towards your equipment stock. So a project-based loan can grow with you into those larger projects. Maybe you're doing 8 projects in a year. Well, what if you want to do 14? Where are you going to, that takes cash. The very nature of the industry you operate in means you don't get paid until at a minimum 60 days after you start the project. 30 days worth of work, 30 days to wait for payment. A project-based loan disperses funds in the exact amount on the exact day into the exact vendor or payroll that you need it for. And it helps you scale from there. For example, we've worked with companies before where they did $20 million in revenue, and I'm using round numbers, and they wanted to get to $40 million in revenue the next year. Now, a bank ain't gonna help you do that because they can't grow fast enough with you. An ABL might be able to do that, but the reality is you need cash for upfront materials. You don't necessarily need the cash after you submit your invoice because you have so many jobs going on. A factor might be able to help you do that, but the thing is you work on a lot of bonded jobs, and some of the jobs you work with are with the government. Or maybe the factor doesn't want to buy all those receivables. Maybe they want to cherry pick those receivables. So that's not a system-wide solution. Now, a project-based loan can be that system-wide solution. So if you have $20 extra million of business that you want to do next year and you have 20% margins, that's 32 gross margins, that is $32 million worth of costs that you have, direct costs between labor and materials that you have, most of which comes out before you even get paid. Now, some of those costs are paid when the cash flow from the job actually reconciles itself and you start getting in the groove of things. But the first 25% of the project, you're coming largely out of pocket. Where are you going to get that cash? A project-based loan is perfect for that. So what is required to get a project-based loan? First off, the company that's going to do a project-based loan, like mobilization funding, is going to take a view of your company, right? Is this a viable company? Is the company known to complete the work that they say they're going to complete? Do they have experience? Do they work with good customers? Are they in a reasonable financial position? But the most important thing a project-based company is going to look at is the project itself. Who's the owner of the project? Who's the GC of the project? What scope of work are you doing? How many people are you putting on the job? How many materials, and on what cadence do you need those materials? And then we map out that project, and then we assess how many customer contributions above and beyond our loan do they need to implement into it. And oftentimes it's zero. The project cash flows itself. So we look at the company, but put much more weight on the project itself. And this allows you to scale your company with confidence. The ability to take on a new job that's larger than a job than you've ever done before and go to bed at night and say, I can confidently pay for those materials, a bigger materials purchase that I've ever made before. I can confidently say I'm going to do that. I can confidently say that I'm going to be able to keep my guys on the job because I'm going to be able to pay them on a weekly basis. And the replicable nature, the repeatable nature of this particular facility in conjunction with your jobs is truly something that you can scale with and hit those growth plans. The only other nuances to a project-based loan is typically there is a funds control account, which those of you who work on bonded jobs are probably familiar with this. There's a funds control account in the customer's tax ID and the customer's name, where it's a project funding account, essentially. So all funds flow through that account so that the project funding company, like mobilization funding, can pay your vendors directly. There's no lien risk on the job anymore because the vendors are paid directly. There's no risk of your guys walking off the job because they're getting paid. So those are really the only controls. This is truly a solution that is viewed more as a vendor than a financing solution, right? If viewed more as a vendor, can be an extremely, extremely powerful tool if your company is in a scenario where you want to grow and you want to scale. This is not rescue capital. This is growth capital. Guys, that's another episode of Business Foundations. Thanks for joining us today. Thank you for letting me talk a little bit about project-based loans. Until next time, enjoy your day.